In psychiatric parlance, the Australian economy seems to be not just two-speed, but to be suffering some sort of dissociative identity disorder. And no one seems sure about the appropriate treatment for its array of personalities. There's the mighty miners, the rueful retailers and the moribund manufacturers, for starters. Add to that the return of inflation and the whole picture becomes more confusing and disturbing. The Reserve Bank Board meets again on Tuesday to discuss whether the interest rate dose needs to be increased immediately, as ANZ's economists now suggest, or raised over time or cut as prescribed by the economics team at Westpac. I spoke to Goldman Sachs chief economist Tim Toohey about the very delicate situation the RBA finds itself in. Well, Tim, you're about the only one who wasn't surprised by this week's CPI, and as a result you haven't changed your interest rate forecasts. But I've rarely seen such a wide disparity of forecasts on interest rates. Some are saying they're going to go up next week, some are saying they're going to go down soon. I mean, what's causing such polarisation among the economists?
Well, I think one of the reasons would have to be that a simple view of the CPI numbers, and assuming all other things equal, you would tend to suggest the RBA may have enough information there to raise rates, purely on what's happened in the 6-month momentum of the data. Now, I think we all know that in terms of the headline numbers, that's been heavily distorted by impacts on fruit and vegetables during the weather disruptions and obviously petrol.
But it's clear that the disinflation's over. I mean, the inflation is trending up, right?
Well, I think we need to be very careful, actually, Alan. If we look at and break down the inflation into different slices, what's very clear is when we break down to the purely domestic economy in the private sector, there's been no pickup in inflation in that regard at all. So if you look at the non-tradable private sector sources of inflation, there's been no pickup. Where the inflation is still emanating from is largely supply-side issues. And some of this is due to, obviously, areas like rents and insurance and education and these sorts of things, which are clear and they've been ongoing, they've been an issue. But in terms of where private demand is at and privately set in prices are at, they're actually very well behaved. Now, one of the things that's happened, though, is that the underlying growth data has deteriorated markedly. So their inflation forecasts are broadly correct. Their growth view is wildly wrong.
In fact, you made some interesting comparisons between now and during the GFC, where growth is actually going back to roughly or round about what it was at the depth of the GFC, or that's what you're saying will happen. Inflation then was higher, 4.5% or so, and at that point the RBA was cutting aggressively. And so, but you are still saying that there's no case for them to cut aggressively this time.
No, I think we need to be careful about saying what would get them what we'd need to see in order to get them to cut rates. And I think a lot more would need to be seen in order to get to that conclusion. In fact, we still think a rate hike will invariably occur, but in the early part of 2012. Now, I think as you rightly point out, what we've seen is a pretty marked deceleration, we think, in terms of both confidence indicators, tightening up of financial conditions more broadly. Of course, the currency is a large part of that. Wealth indicators falling away as well. There are three very important dynamics that tend to drive economic cycles. And all those are flashing red. Now, in terms of the deterioration in growth that we've seen, and of course we haven't got the June quarter data yet, but if it does come in something in the order of around about 0.8%, because let's face it, the export reacceleration due to the anticipated pickup in coal exports out of Queensland just hasn't materialised. We can see that very clearly in terms of the port data. You're looking at a number that may be in the order of about 0.8, 0.9, which would take the headline GDP number down to a level that is very similar to where we got to in a year-on-year run rate during the depth of 2009. So, of course, we can say there's distortions that are doing that, and there are. But the baseline is a little bit worse than trend.
I thought one of the real surprises out of the CPI this week was the tradable goods prices are still rising despite the high dollar.
Correct.
But this must be disappointing to the Reserve Bank. I mean, what's going on there?
Well, I think one of the clear reason for that, I think, is if you look around the world, who'd been tightening rates aggressively? Of course, it was China, India, Korea, had been doing most of the heavy lifting in our region. And of course, they're very significant import partners as well as trading partners on the export side for us. So there's no doubt about it, as they're hitting full capacity, their own wage rates were going up, their own input costs are going up, largely a function of commodity prices out of Australia as well. It's come full circle. and we're seeing a little bit more of that in terms of the tradable side.
So bottom line, what's your call on rates?
Well, we have rates on hold through the course of 2011. We have one last rate hike in the end of the first quarter of 2012.
And no more after that?
No more after that.
And neck on the block, what do you think about the dollar? Where's that going?
There's definitely some near-term reasons why it's still going up. Now, there is, I would put a caveat on it, that as we look a little bit further out to the mid part of next year, the truth serum for the currency will always be, I think, at what point
truth serum?
Well, when your trade accounts start to deteriorate materially. And it seems completely inconsistent that you could have some degree of falling commodity prices, which we are still expecting as our base case, and a material surge in capital goods imports, which would be a direct function of the mining boom, and not see a pretty significant deterioration in the trade accounts. If we get that, the dollar will change direction. Now, at what point do currency markets start to factor that in? I think they'll probably factor it in more as we get into the early part of 2012. In the interim, there is, I think, some pretty good reasons why the A dollar will still continue to drift higher.
Thanks for joining us, Tim.
Thanks, Alan.